A very good evening to all of you. It's my pleasure to be talking to you once again. And I'm aware that today we have a deadline of GST 3B. And we are also towards the fag end of our series on back to basics. And when we started these sessions around 6 months back, the idea was to really reconnect to each of you and try to communicate to you the fundamental principles based on which this ever evolving GST law is being progressed. I am happy to share that we've had good participation and good feedback for the entire course. Our partners and my senior managers who have dealt with each of the topics in this long duration course spanning over 6 months. And today I will be talking about some legal controversies which suggest that GST is more in the nature of a work in progress. After this, we have one more session, which will be the last session of this Back to Basics course. After maybe a gap of 3-4 months, we will run a second series of this. In the meantime, each of you can please share your feedbacks so that we will know which topics should we cover in a bit more detail, and we can tailor make this entire concept to suit the specific requirements of the participants and the needs of the industry. With that little bit of a background, the topic which I am going to talk about today is at a macro level, not a very specific topic, but a generic topic about how GST is a constant work in progress. And this sentence we keep on speaking regularly, and we all correlate with that word in a very detailed manner. But when we say work in progress, I think the work in progress is at various levels. And the first level at which the GST continues to be a work in progress is in terms of evolution, maturity, and interpretation of the law. We have seen that in 2017, when GST was introduced, it was introduced as an amalgam of various existing indirect tax laws being consumed or subsumed into a single GST levy. Even the provisions which were drafted were, to a large extent, in today's language, we say copy paste or cut paste from three distinct sets of legislation. And that's where there were some inherent conflicts in the GST law itself. More importantly, there was a particular mechanism in which the entire workflow was expected to be done when the law was introduced. Over a period of time, there were lots of learnings and a lot of amendments have been carried out, both in terms of the provisions of the law, as also the various supporting legislations like the rules, the notifications, and the circulars. And the pace of those amendments is so fast that at times we might miss out some minute aspect of those changes. So that is the first part where we are seeing a constant work in progress, which is relating to the act, the rules, the notifications, circulars, interpretations, and all of these being interpreted by advanced ruling authorities, which more often than not are conflicting. At the same time, there are High Court as well as some Supreme Court decisions coming on this aspect, which bring out the exposition of the entire legislative background of the GST law. So that is the first piece of discussion where we will try to understand what are some open issues and important open issues and how these open issues might impact the day-to-day functioning of an organization or a business. Having said that, this is how the law has and what are the open positions therein, we also need to understand that as far as the government's administration of this law is concerned, even that administration is a work in progress. When in 2017 we brought in the GST law, the idea was to go a bit slow, and therefore in the first couple of years we did not see a lot of action on the part of the government in terms of ensuring or enforcing compliance or trying to track evasion. The emphasis was to make sure that GST is accepted across the businesses, and therefore the government was a bit slow in the first couple of years. The priority was more on making the industry understand the law, making the industry adapt themselves to the law. But as time progressed, the government found that there were some cases wherein the taxes were being evaded or the law was being abused, which resulted in slowly and steadily the tightening of the administrative mechanism. And with the time barring provisions coming into place, today we find it is very common that the organizations have started receiving notices for assessments, either in terms of ASMT 10 or a DRC 1A or a DRC 1. And matters have also gone, disputes have started arising because of high-pitched assessments or presumptive assessments, and matters have gone into the appellate mechanisms. Unluckily, in this administrative front, we see two major challenges and which we had discussed in the earlier session. One challenge is the non-setting up of the GST appellate tribunal, which means that many matters either get stuck up after the first appellate level, or the taxpayer has to knock the doors of the High Court. And therefore, the High Court is flooded with a lot of litigation as far as the administrative aspects of the GST law is concerned. Along with all of this, the fact that there is a target driven levy and the government is looking at GST as a milking cow, we see that the targets keep on increasing, and naturally perhaps the tax collections at times may not internally keep pace with that targets, and therefore we are seeing a lot of investigative agencies getting involved into the administration, and at times there is a lot of overlap in this administration, and these are again some issues which the courts will have to intervene, and slowly and steadily we'll see some maturity on how the GST law will be administered. Will it be one of the state, either the state or the center? Will it be both of them? When can an scrutiny notice be issued? When can an audit notice be issued? And when can an investigation notice be issued? These are principles which again will be decided and settled and matured over a period of time. But as of today, it's like a free play and an open playing ground. And we see that there are many cases where there is a multiplicity of investigation or multiplicity of action from the end of the department. And finally comes the leg of implementation. And when we talk about implementation, I would divide this implementation aspect into two parts. One is the government GSTN portal itself, including the IRN portal. And we are aware that, yes, in the initial periods, there were a lot of teething troubles. Of late, we understand that, yes, to a large extent, things have stabilized. But hand in hand with the changes in the law and the administration, naturally, there will be amendments in the portal and the processes on the portal. And those amendments are being carried out. And therefore, even over here, we see that there is a constant work in progress. Also, the work in progress comes in at the stage of the industry or the taxpayer, where as time progresses, we have seen that while initially all stopgap arrangements of working through Excel and trying to do a lot of manual intervention was there, slowly and steadily the industry is also moving into a zone where they want to implement this entire thing through an automated process rather than keep on going into every month the executive spending a lot of time in only trying to ensure that the returns are filed in time. So that again is a work in progress. So when we are looking at GST, I think it's a work in progress from all these corners of law, administration, and implementation. And especially when you have this type of a work in progress, naturally, the speed of each of those facets of the progress will be very different. And that's where you will find sometimes the implementation will have to catch up with the law. Sometimes the law will have to catch up with the administration and vice versa. And that's where you will find lots of interplay and uncertainties. And all these uncertainties and interplays will bring both opportunities as well as challenges in the field of the GST. That's what today's session is all about. A constant work, GST as a constant work in progress, and the way forward in terms of opportunities and challenges. What I have tried to do is, of course, we could really speak a lot about this. But what I've tried to do is I've tried to bring out around 10 to 12 broad issues which are plaguing, I would say, majority of the taxpayers. And we'll try to understand those issues in some cases through case studies, in some cases through a basic interaction on the specific points. So what we are doing is we'll first talk about a major impact point which is coming because of introduction of GST. And all of us are aware that because of GST being a dual GST concept, there is a requirement of a state level registration. Especially if you are a multi-locational entity, the first unresolved issue is when is a registration requirement triggered for a multi-locational entities. And I think we'll take 2-3 examples, and all of them there are some conflicting decisions on these aspects already in place. And let's try to understand the controversy in this entire matrix. Let's take an example of a contractor who is located in Mumbai. He obtains a construction contract for some infrastructure project in Gujarat. The work is expected to last for 2-3 years, and because it's a long-term project, the client provides a small earmarked premises within that site where the contractor will construct his site office, erect a temporary site office, where the employees of the contractor will come and perform a lot of activities over there, including at times storage of the materials required for the and equipments which are required for this works contract. The question which comes up here is whether the contractor is required to register in Gujarat and whether he is required to raise the invoices in Gujarat. Now, I purposefully kept a sort of a midterm type of a project lasting for 2-3 years. You could have various scenarios. You could have a works contractor who is undertaking a simplistic repairs job, and maybe he might be there for a month or two. Maybe at times he is not provided a site office. Whether this will change the answers as far as the requirement for registration in Gujarat is concerned. These are some questions which will come up. Now compare that with another situation of an importer who is located in Maharashtra, in Mumbai, again having an office in Mumbai. He imports chemicals through the Chennai port and stores the same in a private warehouse in Chennai after clearance. Now, the issue here becomes relevant because the definition of place of business, as we will see in the next slide, includes a warehouse where the goods are being stored. So, if the goods are stored in the warehouse in Chennai, the question which would come up is whether a registration in Tamil Nadu is required, whether that warehouse would become a part of a place of business of this trader, and therefore warranting a registration in the state of Chennai, in the state of Tamil Nadu. Similarly, look at a case of a stockbroking firm, which again is located having a head office in Mumbai, has front offices in different states, where investors can interact for facilitating registration and trades. As we all know, stockbroking today is more or less an online process, and therefore technically all the activities like scanning of the registration forms and all has to be done online. Even trades are placed online, but the local offices facilitate all these processes to a number of investors. End of the day, all the approvals and trades happen from Mumbai or to online on the portal. And that's where again the question is whether a front office in a particular state will require or trigger a requirement of registration. I think to address those questions, we need to go back to the provisions of the law. And if we go to the provisions of the law, we see section 22 says that a registration requirement is triggered when a taxpayer makes a supply of goods or services from a state. Now, this word is very important. Goods or services they are being supplied from a state. How do you decide from which state are the goods or services supplied in the examples which we gave earlier? Will it be for example, in the contractor's case, will it be Mumbai because the head office is Mumbai, the tender is bid from Mumbai? Or will it be the site office because practically the day-to-day activities of construction, the procurement, and the supply of the goods and services happens locally at the particular state? That is the key question which is going to result in a sort of a legal controversy in times to come. The second situation which requires a registration requirement is a situation where you receive certain goods or services which are subject to reverse charge mechanism in a particular state. So if you are receiving a services in a particular state and those services are a subject matter of reverse charge mechanism, it would trigger a registration requirement. Now, of course, certain cases are simplistic. For example, if there's a transport service which has been procured by a Gujarat unit, in that case, the RCM for that would have to be paid in the state of Gujarat. I am aware that in some cases, organizations have not been able to implement this because the data is consolidated and at times the RCM tax is paid in the corporate office in a particular state. Of course, I would believe that is not the correct implementation of the legal requirement. Taking another example, if there's an advocate who is appointed and working for a particular state, the legal services which are under a subject matter of reverse charge mechanism, the tax will need to be discharged in the state where the advocate has been appointed from. Same thing goes for security services and many other services which would be a subject matter of reverse charge mechanism. As far as outward supply of goods or services from a state and the specific questions which we had addressed in the earlier slide is concerned, I would believe that as far as services are concerned, we have a definition of location of supplier of service and a recipient of service. And both those definitions anchor themselves on the concept of a force of attraction. They say you look at the establishment more closely connected with the provision or the receipt of the service. And based on the tiebreaker test, that establishment will be the establishment which will be required to register and raise the invoice. So if I have to look at it from a contextual perspective, in the first example, substantial performance, or I would say holistically, all the performance happens from the site office locally. And therefore, while there have been doubts on this front, a general view would be to say that a contractor would require a registration in the state of Gujarat, and he would be raising invoice from that location and paying the tax in that location. As far as the stockbroking firm is concerned, while one will say that the activities are happening online, to a large extent, the facilitation of those activities does happen from the front offices in various states. And therefore, definitely a registration for those front offices would be required. A view which is possible to take is to say that those front offices act more as a support to the corporate office, and they raise an invoice as a support service to the corporate office. Or in the alternative, they might say that yes, we are the front office interacting with the investor, and therefore they raise a decentralized invoice on the investor with the corporate office acting as a back office support function. So both those possibilities one may perhaps look at in case of these types of stockbroking arrangements, and depending on how you have implemented GST, the principles of branch transfer will also get impacted because of this point. Coming to the concept of goods, the challenge in the case of goods is that there is no specific guidance provided for situations relating to location of supplier of goods. While we have a definition of location of supplier of service, there is no such definition for location of supplier of goods. Having said so, the place of business is defined, and the place of the business includes any location where the goods are stored or the warehouse, or even the place where the books of accounts are maintained. And then there is naturally a requirement for registration of every place of business. And therefore, coming back to the second situation, where we are looking at a case where the goods are stored in a private warehouse in Chennai, and from there, naturally, they would be directly sold to the end customer. A traditional VAT authority would always believe that the supply of the goods is happening from a private warehouse in Chennai, and therefore a registration would be required. Now, when I'm saying this, I need to tell you that there are a couple of advance rulings which hold that the entity can raise an invoice from Mumbai. In my view, there is a bit of a challenge in those advance rulings. Firstly, as we are all aware, advance rulings are not binding in general. And secondly, in this case, the advance ruling authorities were located in the state of Mumbai. Now, naturally, if a trader in Mumbai goes to the Maharashtra authority and says, let me know whether I can raise an invoice from here, there's no reason why the advance ruling authority will say no. The real test would be to test the advance ruling authority of Tamil Nadu, because that would be the right authority to say whether a registration in Tamil Nadu is required or not. So there's a jurisdictional challenge which also does come in, and therefore one would believe that the place from where the movement of the goods originates should be the place from where the supply of goods is being made, and there would then be a requirement of registration and invoicing from that location. As far as multi-locational enterprises are concerned, the implications of such distinct registrations, we are all aware. This results into slicing of invoicing to customers. I just touched upon in the context of the stockbrokers that there can be a concept of a centralized billing or a decentralized billing, and accordingly, the implementation of branch transfer of services. Yeah, of course, the claim of input tax credit also will get divided based on the number of registrations which an entity would have, and in each of the states, they would be claiming the input tax credit. When we are talking about claim of input tax credit in this context, there is also a dispute which has now started brewing up regarding the concept that the input tax credit has to be in the course or furtherance of business. And that's where, especially if you have multiple registrations, the authorities are now trying to interpret business also to be vis-a-vis a particular distinct person. And let me explain this through an example. Let us say an entity has a registration in Maharashtra and a registration in Delhi. Now, there is a salesman of that company who was originally located in Maharashtra. He is traveling to Delhi and staying in a hotel there for a business purpose. Naturally, the hotel will charge a local GST. We are all aware that hotels, the C plus S GST only is applicable. So this executive shares the GST number of the Delhi branch instead of the Maharashtra branch, and he instructs the Delhi branch to claim the input tax credit. Now, can the Delhi officer deny the input tax credit to the Delhi unit by saying that, look, the executive who has traveled is of the Mumbai unit, And therefore, he is connected with the business of the Mumbai unit and not the business of the Delhi unit. And we are aware that some controversies on this front have started. In our view, the concept of business does not get sliced. The concept of distinct persons given under Section 25 will have to be dealt with only vis-a-vis the specific aspects of registration, identifying the invoicing, and that's it. Beyond that, you cannot slice the business, because at the end of the day, the business is of the entity as a whole and not of a specific particular branch or a particular unit. And therefore, in our view, there should not be a challenge in claim of input tax credit, but we are aware that show cause notices have been started on this aspect, and therefore one will have to be careful on this front and minimize the incidence of these types of examples as much as possible. Of course, in case of hotels, there is no way out, but for other expenditure, it may make sense to link the expenditure and the corresponding business and the revenue of a state, especially in case of recipient-based baskets. Branch transfer of goods, I think more or less all the organizations have implemented it reasonably well, so I'll not take time on that aspect. But yes, again, over here, we will now see situations of valuation being questioned and other situations coming up, especially in cases where full input tax credit is not available to the recipient unit. As far as branch transfer of services is concerned, either depending on a centralized or a decentralized billing, we need to either bring in a branch transfer of service from a branch to a head office or a head office to a branch. Please make sure that we don't end up in a situation where we raise a branch transfer of service invoice without there being any service at all. Now, this is very important because one may not look at branch transfer of service as a mere mechanisms to transfer input credit from one registration to another. We have a classic case of JSW Steel, wherein the Orissa High Court frowned upon this type of a mechanism. It was a situation where the Orissa branch of JSW Steel had a substantial input credit on account of payments made towards royalties, and it sought to transfer that input tax credit to the head office in Mumbai by doing a branch transfer invoice. And the High Court said that we do not see any element of service being rendered by the Orissa unit to the Maharashtra unit, and therefore we are not comfortable with this process of transferring of credit. And therefore, while it's in a way a double-edged sword, if you don't undertake a branch transfer of services, the officers are going to show you a Columbia Asia decision and say that, look, in view of Schedule 1 Entry 2, you are required to do a branch transfer of service. But having done a branch transfer of services, if the whole objective of doing a branch transfer is only for transferring of credits, and there is really no element of a service which can be defined between the sending and the receiving branch, you might face up the challenges which came up in the case of JSW Steel. So these are some issues which come up in a multi-locational enterprises in terms of day-to-day implementation. Having said that, what we are also seeing is a lot of challenges which these entities face in terms of adjudications. And again, we are not even talking about the plurality of the agencies and the aspects of adjudications. So you might have something called as a scrutiny, something called as a audit, and then you have a show cause notice. At the same time, you have anti-evasion, investigation, and the state center overlapping jurisdictions. We are not even going into all of that. But a very simplistic aspect, and especially I understand a couple of states have started this exercise. They are now comparing either the financial turnover with the GST returns, or they are comparing at times the TDS turnover with the GST returns. Now, in the service tax regime, we have all dealt with it and we have seen the pains of this approach. In GST, the things become even more complicated because you are not comparing only two distinct set of databases. You are also keeping in mind that as far as GST of a particular state is concerned, the starting point itself can be only the state level turnover and not the financial turnover of the organization. And at times, if an entity is registered in 15-20 states, many of those states might ask for a reconciliation of financials with the state level trial balance. And in a way, they might want to pounce into the turnover of other states. Now, to what extent can this be permitted, especially when the situs of that particular state is only related to the intrastate supplies of that state? This is something which is going to become a huge bone of contention And especially in many cases of services, especially if they are dealt with by the state tax authorities, we might find that they may not appreciate the fundamentals of accounting process or the intangibility of services, and therefore duplication or multiplication, even maybe not even duplication, but multiplication of demands by disallowing a same type of a transaction in multiple states might also come up as an issue as time progresses in adjudications. So this is one more aspect which one will have to be slightly careful about and mindful about, and we might see some major challenges on this front where courts might need to intervene to resolve these types of multiplicity of demands. As far as investigations is concerned, again, whether the investigations should be limited to a specific state, especially if it's undertaken by a state authority, or whether it extends itself across the pan-India jurisdiction, and whether questions can be asked relating to other states. These are some questions which definitely are going to come up. And a time immemorial question on a conceptual front, which keeps on coming up, is whether an input service distribution registration is mandatory or whether it is optional. As we are aware, the FAQs are saying it is optional, but there is a draft circular and there are a couple of decisions where the advanced ruling authorities have tried to delineate the scope of a branch transfer of service and the scope of input service distributor. In our view, all of that is too hyper technical. The concept of input service distributor itself says that if you opt for those mechanisms, and therefore I would believe that it is clearly optional. Even the FAQs are suggesting that it is optional, and I think we should go by that thought process and be ready with some type of an explanation as and when the issues do come up at a ground level. That takes me to the second aspect relating to outward supplies, and the fundamental issue which comes up is the very wide definition of service given under the concept of supply. And we are aware that service is defined to include anything other than goods. And a fundamental question which comes is there a boundary to what can be covered? Can you typically say that a sale of an office is a service and therefore ideally it would be liable, but because of Schedule 3, it is not liable? Can you then also expect a reversal of input tax credit on that front? These are fundamental questions, because if service was defined to be anything other than goods and in all transactions can be services, they could have named it as a transaction tax rather than as goods and services tax. When they talk about the word service, the basic essence of a service needs to be present, and therefore there is a possible view that supply of immovable properties, sale of businesses, these are not services, and they would neither be goods nor be services, and therefore not be a part of the GST regime at all. Same way, many a times there could be a group company which incurs a common cost, let us say buying IT licenses, and because if you buy more than 10 licenses, maybe there's a concession available. So group company A requires 7 licenses, company B requires 6 licenses. So what happens is, rather than both of them placing separate orders and paying a higher price, they agree that, okay, a common order of 13 licenses will be placed and 6 will be used by B and 7 will be used by A. Now, this is typically a cost sharing arrangement. If it's on a like-to-like basis and it is amongst the group companies, whether the recovery of the cost from a group company, whether that amounts to a service and whether that is a subject matter of GST. Under the service tax law, we are aware that there have been quite a few decisions saying that these cost sharing arrangements do not entitle a provision of a service by one company to another, and therefore there is no requirement to discharge any service tax. I would believe a similar principle should apply to GST as well. Only challenge which comes up in GST is the fact that the credits are also eligible on the basis of matching, and therefore if a view is taken that a cost sharing arrangement does not amount to a service, in many cases this results in a disruption of an input tax credit chain, and therefore most organizations would prefer to take a conservative position. In this example, A would claim credit of 13, charge a GST on 6 units which have been given to B, and B would claim the credit of 6 units, and it will flow in the 2A, 2B accordingly, and the credits mechanism will work seamlessly. But if a view is to be taken that no, 13A is only acting as a facilitator and actually 7 is received by A and 6 is received by B, there will not be any problem in the claim of credit of 7 units by A. But when it comes to B and he has to claim a credit of 6 units, the transaction will not appear in B's GST returns. And therefore, the matching process and all will create a difficulty. And therefore, for B, claiming credit becomes difficult. And that's where most of the organizations today prefer a conservative view for cost sharing arrangement, which is also making a business sense, because otherwise there would be a loss of credit. Same situation happens in case of pure agent transactions. In many cases, one may be in a position to argue that I am only a facilitator in booking an air ticket for XYZ, maybe my group company, or maybe my director, or someone, or maybe my parent or a subsidiary. But end of the day, the issue because of matching of credits will always come in. And moment you bring that into picture, one would want to be a bit conservative and take a position that yes, I want to maintain the chain. And if I want to maintain the chain, I need to raise an output invoice on that group company. As far as penalties and liquidated damages is concerned, it has been a long story right from the service tax days. We are aware there has been an entry called agreeing to do or tolerate or refrain from doing an act. And this, the department kept on interpreting very widely to cover all types of penalties and liquidated damages. Courts did not look at it that way. They used to say that these do not constitute a service at all. And therefore, there's no question of paying any taxes on these transactions. And recently, the CBC had to intervene and a detailed circular has been issued explaining various situations of penalties and liquidated damages and how they do not constitute an agreement to do or tolerate an act. And therefore, they are not liable for GST. A very classic example being a notice period recovery. I am also aware that many of us would have taken a conservative position to recover taxes or notice period pay. But in the light of the recent circular, I think even those conservative advices can now be ignored, and one may want to not pay the taxes on notice period recoveries and penalties which are being recovered on that account. A lot of challenge comes up in interpretation of various government statutory functions and whether they constitute a service, and it becomes more important from a private sector perspective because government services are qualifying as reverse charge mechanism under reverse charge mechanism, and therefore it is the private sector who avails these services from the government which is required to pay the taxes. Again, in the service tax regime, there was a circular which said that any statutory authority performing a statutory function does not amount to rendition of service. While there have been a certain deeming fictions under the concept of business, the larger picture which would come up is when I pay a particular amount to a municipal corporation or a government under a statutory force rather than receiving any user service, can that be treated as a service, and whether there can be a GST applicable at all. In the context of mining royalties, the matter is pending in the Supreme Court, and we will really have to see how the Supreme Court looks at this issue, and accordingly maybe we will see some resolution to this aspect of GST on government related services. We also see situations where an entity receives advances for services. We are aware that based on the definition of supply, which includes not only supplies made but agreed to be made, and also the time of supply provisions, such advances for services become liable for GST. At a later point of time, if the service is not really rendered and the advances are returned back, whether there is a tax implication, whether there could be mere receipt of a money and writing back of that money as a whole would constitute a taxable event of a service, and whether tax is payable. Again, the circular does try to clarify on the cancellation fees and aspects relating to it. I would believe that conservatively one may go by it, but otherwise, on a practical perspective or a purely legal perspective, one may say that in the absence of a rendition of service, there cannot be any GST at all in these types of situations. But this again will have to be tested as time progresses. Another important situation which we are seeing day in and day out, and we always frown upon this aspect, but well, the department does keep on doing this, is the presumption of a supply. And courts also have frowned upon this. But end of the day, what happens is whenever there is a supply, the onus to establish a supply would lie on the government. Having said so, if there is a supply, that supply, the values of the supply would come out in your financial turnover, or the values would get identified in various situations. And therefore, the department would actively expect a reconciliation between these different touch points. And based on the reconciliation, if there is even a small difference, we find that in today's age of automation, many a times straight away a notice is being issued asking that, look, I see your financial turnover to be X, I see your GST turnover to be Y, and therefore, since X is greater than Y, we believe that supplies valued at X minus Y have escaped assessment, and please pay a GST on that X minus Y. Now, this simple letter, which goes to thousands and thousands of taxpayers based on computerized data, which compares two dissimilar touch points, sets into motion activity at each organization's end. Now, each organization has to run helter-skelter, trying to find the difference between X and Y, and the reasons for those differences. There could be n number of differences, reasons. It could be an example of an unbilled revenue. And many cases we find the basic difference is that X and Y itself have been wrongly plotted. Many a times they have been plotted from some another entity, or sometimes they have been taken on the basis of presumptions. And in those types of situations, if the time allowed is limited, many a times that demand gets confirmed. And that's where a legal principle which comes in is to say that the department cannot presume that X minus Y is essentially a service or a sale on which GST is payable. The department will have to identify the goods or services which have been supplied, which have escaped assessment. They will have to identify the HSN for those goods or services, accordingly identify the tax rates, and then only raise a valid demand. Just a difference may be a starting point, but it cannot be a point for a show cause or an adjudication resulting in a valid demand. So that is an aspect which one needs to keep in mind. Similar situation happens in case of e-way bill data with GST turnover, or to that extent even IRN data with GST turnover. At times, based on a simple reading of an agreement, or department tries to presume barters between two entities. A classic example being a redevelopment agreement. Again, the situation is that you may not be able to presume a supply, and this again is going to be a legal principle which will come up in the courts as time progresses. Job work, there is a requirement. If you have sent goods on job work basis, you are required to receive it back within 1 year. If you receive it late, then there is a deeming supply provision which deems that to be a supply by the principal to the job worker. And again, the question is whether that presumption is valid. Same way for export transactions, you are required to realize the money within 1 year in case of services. If in foreign exchange, if you don't receive it, there is a provision which says that you are required to pay a GST on delayed realizations. Again, that is a presumption which can be questioned. So those types of questions are going to come up as time progresses in terms of the supply side. That takes me to input tax credit. And input tax credit, I think, largest issue has been matching. We are all aware that up to 1st January 2022, the provisions of GSTR 1, 2, 3 were not operational. We had an ad hoc GSTR 2A, and we had a lump sum figure of input tax credit appearing in 3B. And in the absence of legal provisions, a lot of cases, taxpayers have argued that even if there is a mismatch between GSTR 2A and 3B, no demand can be raised. Having said that, the department have raised demand notices or tried to demand tax, and most of those cases are sub judice as of now. In our view, when you are looking at periods up to 2019, when Rule 36(4) was introduced, up to that period, clearly there was no mechanism to enforce matching or to only give the credit based on the appearance in GSTR 2. After that day, there was a tolerance limit. We are aware of the tolerance limit. In one of the earlier sessions, we have dealt with it, which started with 20% and slowly reduced to 10, thereafter 5. And from 1st January 22, it was reduced to 0. So for that period, from 2019 up to December 21, naturally, if you are within that tolerance limit, there should not be a problem. If you exceed that tolerance limit, then there's a challenge. On this aspect, Maharashtra government has issued an internal circular wherein they have clarified that there could be a number of reasons why, though the tax has been discharged to the government, it does not appear in 2A. It could have been uploaded in the B2C section or against a wrong B2B number. And therefore, the Maharashtra internal circular suggests that if a taxpayer is facing this mismatch, he can approach his vendor and obtain a certificate either from the vendor or his chartered accountant, explaining the facts of the case and demonstrating that the tax has been paid. If there is a proper demonstration of the tax being paid and a certificate from the vendor or his chartered accountant, the circular suggests that the credit should not be denied. So I think that is one important process which taxpayers will have to keep in mind and make sure that they try to comply it to the extent possible in case of mismatches, so as to reduce the tax demands to the extent possible. More importantly, while the department in all these examples of 2A, 3B mismatches will bring in just a summary level demand, it is important for the taxpayer to really bring out specific instances which resulted in the mismatch and identify those instances and the causes of those transactions not appearing in 2B and accordingly respond to that notice rather than just write a generic template to say that the credit is, the matching process was not applicable at that point. Another aspect of input tax credit, which is of course a burning issue as of now because it's very recent, is a recent circular issued by the government, which suggests that you need to start your claim of credit based on the figures reflecting in your GSTR 2B rather than in your books of accounts. That does not mean that whatever is available in 2B is eligible as a credit. It merely says that your starting point in the returns will be the GSTR 2B. You would thereafter match it with your books of accounts, identify your eligible credit, and naturally there will be a difference. Your eligible credit will always be a subset of the GSTR 2B figure. And the difference between GSTR 2B and the match credit will have to be reversed. Now that reversal can be either a permanent reversal because it's something like a block credit, like a motor car purchased, or a food and beverage credit, etc. Or it could be a temporary reversal. A classic instance of a temporary reversal will be a situation where the vendor has uploaded the credit in the month of, let us say, September, whereas you have accounted for it in your books of accounts in October. So there could be timing differences resulting in these temporary reversals. And now the GSTR 3B has been amended to specifically provide for this information in terms of the starting point of ITC being GSTR 2B. From that, reducing the temporary and permanent reversals, and thereafter arriving at the eligible credit for the particular amount. So that, of course, is a big process change. In many cases, it may be difficult to implement in legal parlance as well as administrative parlance. In legal parlance, it may be difficult because the section 16 says that you can claim a credit only if you have a valid invoice. If I start with 2B, there could be examples where I don't have an invoice on hand on that day. So in a way, the law is, the circular is requiring me to do something which is not contemplated by the law. Administratively, identifying, if I don't have an invoice, how can I identify whether it is a temporary reversal or a permanent reversal? And therefore, the difference between 2B and my books, which is going to be either temporary or permanent reversal, this allocation itself to a large extent will be ad hoc. Having said that, I think all of these things can be implemented in a simplistic manner with not 100% precision, but on best case basis. And we would believe that wherever we do not have information about whether it's a temporary or permanent reversal, better keep it in temporary reversal. And at any future point of time, we realize that it is not temporary but permanent, we can move it from the temporary basket to the permanent basket. The next aspect on input tax credit, which is again an open controversy, is many cases there are allegations of fake invoicing. Of course, there is a detailed circular which was issued of the consequences in such situations. And this is where one will have to look at what is the onus of a taxpayer to establish the receipt of goods or services. The delivery challan, the receipt of goods in the factory, the e-way bill, payments by account paychecks, reflection into a payment of taxes in time. All of this may be important, but the department is growing smarter. and it is finding n number of different circumstantial evidences to suggest that you had not received the goods or services. A one-line caution which I always give is, as far as possible, or rather in all cases, please stay away from these types of situations, because this really brings a bad name. This results in a lot of penalties, not only in the indirect taxes, but it has consequential ramifications in the direct tax as well as in the accounting and corporate governance space. So as far as possible, we should avoid to go into this zone, and we should be careful to make sure that yes, we would have sufficient documentation to establish the receipt of goods or services in all situations of transactions. A next issue which comes up because again of a recent amendment is a situation of applicability of interest, especially in cases where you have a consistent accumulated credit. We are aware of Rule 88B, which has been introduced to say that if you have accumulated credit, you have wrongly availed the credit and you reverse it, no interest is payable, subject to that much credit being lying idle throughout the period from between availment and utilization. Can I extend that principle to cases where I have failed to pay to the vendor within 180 days? My answer would be, on a literal reading of the law, perhaps no, because the interest in that situation is governed by another section, and that section does not give any respite in case of accumulated credit. Of course, one may want to refer to Refex Industries and say that the government was not out of pocket in this situation as well. Rule 88B also revalidates that out of pocket theory, and based on that, one may want to argue that no interest should be payable in these types of situations. And one major issue which has no answers in the law, but through the portal, is a case of a POS conflict. As you are aware, you might receive services or goods from some third party. The tax will appear in your GSTR 2. But along with the tax, there is a column called the place of supply. And if the place of supply uploaded by the vendor does not match with your state code, then the GSTR 2B treats it as an ineligible credit. Now, while the GSTR 2B does that, when you refer the act, there is no provision in the law which says that just because the place of supply is distinct, therefore you are not eligible for input tax credit. In our view, there is no such provision of denial of input tax credit, and the credit should be allowable. And this is one example where you would see that constantly the portal acts in a manner which is distinct from what has been mandated by them. This is one more interesting issue which keeps on coming up. And this issue can cut corners from both the sides. We have the definition of supply which says that supply is taxable only if it is in the course or furtherance of business. Similarly, when you claim input credit is also available if the goods or services are received in the course or furtherance of business. Now, we deal with a practical situation which had happened in one example, and this will drive home the aspect of the controls. We look at an example where a company who is dealing in plastics, its business is into plastics, has surplus funds and invests in gold. The vendor charges GST, and the question which comes up is, can it claim the credit of the GST charged by the vendor on the gold, which is lying in its fixed assets as an investment? In our view, the gold is purchased by the company, not in the course or furtherance of business. The company is not into the business of gold at all, and therefore, ideally, it cannot claim that. Having said that, after 3-4 years, if the company sells the gold, whether there will be a GST on the sale, again, the answer would be no. But having said that the answer would be no, the department at this point of time would want to interpret business very widely. And that's where you will find that you are in a catch-22 situation. In the first situation, if you would have claimed the credit, the department would come back and deny you the credit by saying that you are not in the business of gold. In the second case, if you don't pay the tax on the sale, naturally, if you have not claimed the credit at the purchase and again you pay the tax on the sale, it results in double taxation. So answers have to be similar in both the cases, but whichever answers you take, the department is going to look at it a little bit differently and create a difficulty in this type of a scenario. But as far as we are concerned, our views on this front would be that this does not constitute a business, and therefore neither credit can be claimed nor output tax is required to be paid on this front. Further, there is no question of reversal of any input tax credit because this is not it's not a supply at all. The definition of supply itself excludes supplies, itself requires that the supply should be in the course of further. Of course, if there is any common credit, we have a rule which requires you to reverse 5% of common input tax credit for non-business use. Again, this is one rule under sub-rule under Rule 42, which we see is mostly complied by non-compliance. Most of the places, the view is being taken that everything that an organization does is in some way related to its business, and therefore this rule of 5% of common ITC reversal is not applicable. Now, this is a position which again will get tested as time progresses, and we'll have to see how it moves. As far as CSR expenditure is concerned, I think in an earlier session we already talked about it. The CSR expenditure is a compliance requirement, but it is not a part of the business of an organization. Therefore, expenditure incurred towards CSR purposes cannot be claimed as a credit. Similarly, when you're looking at personal expenditure of employees, unless you are able to bring in a business angle to it, you will not be able to claim the credit. Of course, if it is something wherein there is a direct business benefit, one may be able to claim. But if it is something like let's say a picnic or which has direct personal benefit with an indirect benefit by way of a staff welfare, that would not really entitle you to claim the credit. That takes me to the last aspect of today's discussion, which is relating to documentation. Again, the question as time progresses will come is today we have a large repository of digital records, right from the stage of generation of the invoice to the stage of accumulation of all those invoices in GSTR 2B, the e-way bills. There's just too much of information on the online. With that level of information, what would be the expectation of the authorities in insisting on physical documentation? Whether scanned copies of the documents can be produced, and these are questions which will come up. Of course, there are provisions in the law which say that a scanned copy of an original document will be an eligible evidence, and one may need to invoke that documentation requirement and identify that type of a situation. As far as e-way bill interception is concerned, there is a circular which says that if it is only for apparent procedural lapses, then no penalties should be imposed. But we see that moment e-way bill goods are intercepted in transit, penalties are invariably imposed. And earlier there was a tax interest and penalty imposed, but nowadays, because of an amendment in the law, there's a 200% penalty being imposed, no tax being demanded. Interestingly, the penalty is said to be 200% of the tax evaded. And therefore, a legal question which comes up is, if admittedly there was no tax evaded, can a penalty be imposed? And if tax was evaded, is it open for an officer not to demand a tax, but only demand a penalty? These are some fundamental legal issues which have, in due respect, we think the ministry has not thought over these issues and can result in some legal difficulties at the later point of time. Another aspect which comes in is, it's always understood that an e-way bill is a document which is to be accompanied along with the movement of goods. Once the movement of goods is concluded, thereafter the e-way bill document has no significance. Despite that, we see many cases where, based on the summation of records of e-way bill portal and the GST portal, some reconciliation notices or penalty notices are sought to be imposed. In our view, once the transportation is completed, thereafter, any error or non-compliance of e-way bill provision cannot result in a penal provision. Job work, we talked about delayed receipt of materials, whether there can be treated as a supply itself is a big question mark. Also, a question which comes up is what is meant by job work, because the definition of job work apparently is very wide. I would believe the essence of job work would still be that the job worker has to be a part of a manufacturing process and not a simplicity repairs or a small activity being done. And the original traditional understanding of job work under excise would still be relevant in an overall understanding of this matrix. Various notices and random information requests keep on coming by emails, and notices on the portals. There have been a couple of decisions wherein there has been an emphasis on not only serving a notice on the online portal, but also in a physical mode. But I think we should use them as shields rather than weapons. As far as any document or either by email or by notice comes and it is visible to us, we should immediately try to respond to it to avoid unfavorable consequences in the future. Of course, summons at times department is aggressive in issuing summons and courts have to interfere. Recently, there was a circular also issued by the CBEC explaining that the summons should be used only as a last resort. And in certain needful cases, maybe we can use those circulars to our advantage and bring it out, especially if the summons is issued for a very short notice. Maybe one can buy time by using and quoting those circulars. I think these are some of the points which I thought were open-ended as of today, and therefore would merit attention of the general participants profile over here. If there are questions, we can take one or two questions. And of course, I am happy to have you all on this series of sessions, which we keep on doing. As I started saying, we look forward to your valuable feedback, and based on your feedback, we will keep on amending this series of sessions which we do. The next series we may start sometime in January. As you are aware, over the next 3 months, all of us would be very busy in ensuring compliance with the annual returns and the GST informed GSTR 9 and 9C. I would also suggest all of you to share the data to your respective teams at the earliest, so that we could make sure that the returns are filed within the respective timelines which have been mentioned under the legislation. We are aware it's 31st December as of now, and looking at past experience, we do not see a scope of an extension on this front in this year at all, and therefore would suggest that you send in the data at the earliest point of time, so that we can start working on those data and start providing you the reports accordingly. With that, I think I'm not able to see a question from the audience. And I think that's all from my side. Thank you very much for a patient hearing, and looking forward to see you in person in times to come. Thank you.